If you could, would you liquidate your life insurance policy for financial gain? Will a life settlement allow you to do just that? In what circumstances is a life settlement transaction appropriate? Is public information available on the life settlement process? What factors determine the price paid for the insurance policy? What are the tax ramifications for such a transaction? Hello, my name is Attorney Ramsey Bahrawy, and welcome to Your Money, Your Life. In this segment, my guest is Dr. Andrea Brockman, a former holistic dentist. Today, she's the Chief Communications Officer of Lifetime Horizons LLC, a company that facilitates life settlement transactions to privately pay for senior long-term care retirement needs as well as philanthropic purposes. Dr. Brockman, welcome to Your Money, Your Life. It's great to have you on the program.
Hello, thank you.
Our topic today is, what is a life settlement transaction? How would you answer this question for our viewers?
Well, the straightforward explanation is that a life insurance policy is an assignable asset like your home. And that means that the owner can sell and assign the policy to anyone that he or she chooses. In the case of a life settlement, a third party purchases the insurance policy for a cash sum that is greater than the cash surrender value, but less than the death benefit.
If a life insurance policy is assignable, does that mean that anyone who's the owner of a life insurance policy can enter into a life settlement transaction, or are there restrictions?
Well, there are restrictions. The person must be of sound mind. They must own the policy for a minimum of 2 years. And in order to qualify for a life settlement, there are certain restrictions of health and of life expectancy.
Can you give a little more detail on the issue of health and life expectancy, please?
If a person does have some medical complications such as heart disease, diabetes, obesity, history of cancer, these things would help to qualify for a life settlement, which is the exact opposite of qualifying for a life insurance policy. So the more medical issues a person has, the better the chances of qualifying for a life settlement.
So if you have a person who has a host of medical issues and has a decreased life expectancy, how do they go about applying for a life settlement transaction? Is there an application process, or what do they do?
Well, that's a good question. The first thing is that they would need to be aware that they have a life insurance policy and to see if that does qualify. And the best thing to do would be to contact a broker who deals in life settlements. And then there would be a very short question and answer that the broker would receive just to determine things like the age, the gender, if there are any medical complications, what type of policy, how long they've had the policy, certain things that are general questions, just to find out if that in fact would be something that may qualify for a life settlement.
Along with that application, does the owner of the policy need to provide any documents such as the copy of the life insurance policy, any medical records, or any other types of documents?
Well, once you find out that there can be some qualification for a life expectancy, then you go on to the next step, which is filling out a detailed application. The person signs a HIPAA form so that their information is protected. There are disclosures that will give the options of things other than a life settlement, signed release forms from the insurance company to release their information, medical release forms, things like that.
So there are really no documents that the person needs to provide, but rather sign a HIPAA form so that the investors can go out and acquire these documents themselves.
Well, usually that's provided to them by the broker.
I see. Okay. So let's presume for a minute that a life insurance policy has been sold. After it's been sold, what happens? I mean, what happens to the policy? Who pays the premiums? What happens after that policy's been sold?
If it's been sold in a life settlement, the person no longer has to pay the premiums. The premiums are picked up by the purchaser. And I'm sorry, the next question?
And in the insurance policy, is there some sort of process for either transferring the policy to somebody else, or what does the owner of the policy have to do to make sure that the policy actually is transferred to the investor?
The owner of the policy, once they have signed the forms, the life settlement would be complete. The money is then transferred to the insured, or to, in some cases, a charity. And they have an option of being able to decide if they even want to keep that as a life settlement for 15 to 30 days, depending on the state that they live in.
And what's the reason for this 15 to 30 day period?
It gives them an opportunity to change their mind if they don't want to go through with the life settlement.
I see. So it's kind of like a second look, be able to reconsider the situation, and they'll have, as you said, so many days to do that. And then if they decide to cancel the transaction, I presume they have to return whatever monies they received. Is that correct?
That's correct, yes.
Why would anyone consider entering into this type of a transaction? I mean, what motivates people to do this?
There are a number of things that can happen. The premiums may become unaffordable. That's usually the biggest reason. They need the money for long-term care. They may have debts that they want to consider paying off. They may want to give cash to family members. Any number of reasons. Retirement communities, whatever they want to use the money for.
I would have to presume that a life settlement isn't appropriate in all circumstances. So could you address those circumstances where a life settlement would in fact be appropriate?
Well, I could tell you where it wouldn't be appropriate first, and that would be if the person has heirs that they want to leave money to. In that case, they should not consider a life settlement. It would be appropriate if the person decides that they can no longer afford the premiums. Also, if the insured has outlived the beneficiary. That would be a perfect example of entering into a life settlement. In the case if there's a surviving spouse and there has been a survivorship policy, and the surviving spouse may find that they can no longer afford the premiums, or they don't need as much coverage. There are cases when the estate has changed. They no longer need to take out a life insurance policy to pay the estate taxes. And then there are a lot of people who may need to use money for long-term care, that they don't have long-term care insurance, or they want to go into a retirement community.
Are there circumstances where a life settlement transaction would be inappropriate?
Yes. It's inappropriate if they want to leave money to heirs. It's also inappropriate if the person is not of sound mind.
Okay. Now, we talked a little bit earlier about the fact that an insurance policy would be sold through this process. What factors determine the price paid for someone's insurance policy?
That depends on the type of policy, how much has been put into the policy, what the cash value is, their age, their life expectancy, gender, medical history. These are some of the things that would affect the value.
Now, if an individual who's the owner of a life insurance policy receives a quote to sell that policy and is unhappy with that, can they, as a consumer, go out and shop around? Is that a possibility?
Absolutely. The consumer always has the right to shop around. They will have their own expenses and fees that they will incur, whereas when they do go through a broker, they don't have those fees.
Explain that for a minute. Why is it that they would have fees if they did not work with a broker, but would not have fees if they work with a broker?
Well, there would be fees that would be coming from obtaining their medical records, which could depending on the doctors, because they have to get medical records from copies from all the doctors that they've seen. That could be thousands of dollars. They also have to get several what's called life expectancy reports. Those run at least $300 a piece. There could be transaction fees coming from the providers or the people that actually pay the life settlement. And depending on how many people they are going to shop around to will depend on how much those fees will be.
How can a consumer who's interested in selling his or her insurance policy tell if he or she is getting a fair price? How do they know?
Well, the cash surrender value could be something that they could look towards, because the life settlement is usually 4 to 5 times the cash surrender value. In the case of some term insurance policies where there is no cash value, they're actually getting money that they didn't even know they had an asset.
I'd like you to consider for a minute that an offer is made for a life insurance policy, and the owner of the policy accepts that offer and then thinks about it and decides he or she wants to change her mind. Is it an option to change her mind? Are we talking about that 15 to 30-day period you mentioned earlier? And is that what they're limited to?
That's correct. So they would have the 15 to 30 days to change their mind. None of that money could have been spent. All of it has to be returned to the investor.
And if they did spend some of that money, they can't change their mind?
They can change their mind, but they just have to come up with the money.
Have to come up with the money. Okay. Could you detail for our viewers what you believe to be the pros and cons of somebody selling their life insurance policy?
Yeah. The pros are, number one, they don't have to pay any more premiums. The premiums are picked up by the buyer. They receive cash for an asset that they may not have known had that value. The settlements also that, like I said, they are 4 to 5 times, even sometimes higher than the cash surrender value of a policy. Some of the smaller face policies that people have, which can be about $50,000, $100,000 policies, these can be used for a Medicaid spend down. Also, people can use the proceeds from a policy to purchase an annuity, or they can use it for tax-deductible philanthropic needs.
Andrea, what I'm basically hearing from you is that people can actually receive a cash benefit from a life insurance policy where they can no longer afford the premium, or a life insurance policy that they may have and may disqualify them for certain public benefits, and they in fact could receive those cash benefits in order to be able to either improve their lifestyle in retirement or pay for care in an assisted living facility or a nursing home. Am I hearing that correctly?
You are hearing that correctly. This life is, in many states, life settlements are considered, they're able to be used for Medicaid spend down, which means that that money that comes from a life settlement can be put into an account and paid directly to the facility that they are staying in. And that could be an assisted living facility, it could be a skilled nursing care facility. That money can be used as long as the benefit lasts to pay for that, and until the person is then entitled to become to get onto Medicaid. And a portion of that cash settlement can go towards funeral expenses as well.
Does the seller of a life insurance policy incur any transaction costs when engaging in a life settlement transaction?
There are no transaction costs as long as they go through the broker. Now, there are tax implications, which, would you like me to go into that?
Yeah, let's talk about some of the tax implications. So if somebody sells a life insurance policy and they receive X dollars in cash, are there any tax implications from that sale?
Yes, but the first thing that a person who is interested in going through a life settlement should do is contact their attorney or a financial advisor to see if this, in fact, is the appropriate thing for them to do. There are tax implications. I am not a tax advisor, but I do know that there are tax ramifications that may include ordinary income and capital gains, and unless it is donated to a charity, in which case that there will be very good tax implications.
Could you explain to our viewers why a life settlement transaction is preferable over the owner of the policy going out and borrowing against the policy for the money he or she needs?
In the case of borrowing against the policy, a borrower can only have a certain amount of money that can be borrowed. There is no cash value in a term policy, and the insured must still pay the premiums. Plus the fact that if a borrower will take proceeds against their policy, that will lower the death benefit. However, borrowing is the best route if they do want to leave money to their heirs.
A lot of people, as they age, look towards public benefits and also engage in what's called asset protection planning, where they try to protect their assets. Someone selling a life insurance policy now is coming into a certain amount of money, which is likely not protected by an asset protection plan and likely also disqualifies them from any public benefits. Wouldn't that be a negative for some people in terms of engaging in this type of transaction?
For people who are in programs like food stamps, Medicaid at the present moment, yes, that would be something that would not settle with a life settlement. However, if they do what was called for the Medicaid spend down, they would still have their assets protected, providing that that's spent down in order to qualify for Medicaid. If they don't have to go through this asset spend down and they do have money that they can pay for their long-term care or whatever it is that they need, then this is not an issue.
With regard to Medicaid, Medicaid has very stringent asset and income guidelines. They're so stringent that most people really don't qualify. And so you're right, people then have to go through what's called a spend down process, where they spend their assets and their income down to the appropriate level so they can qualify for Medicaid. In Massachusetts, it's called Mass Health. And then it's important that our viewers understand that Medicaid is the only public insurance that'll pay for long-term nursing home care. And so that's a process that needs to be planned for at least 60 months prior to the time that you go into a nursing home. So Andrea is right, a spend down process is necessary, and it's better that you do it sooner rather than later. Now, you mentioned a little bit earlier that as part of the application process that the seller has to sign a HIPAA form allowing the investors to obtain all sorts of health information. How does the seller or the consumer know that that private health insurance information will indeed remain private? How do they have that knowledge?
Well, that's what a HIPAA form is for. And that does protect the person from having this information get leaked out to anyone.
Well, what the HIPAA form does is the HIPAA form provides authorization to release information to specific identified individuals or entities. How does the seller know if they're dealing with, let's say, you as a broker, that you're going to keep that private health insurance information private?
And it's always something that we have abided by in terms of keeping information private. As brokers, we have a code of ethics that we follow, which would maintain that we keep the information private, which we have done as life insurance settlement brokers and as well as in our previous careers as dentists.
As a life settlement broker, are you required to be licensed?
Yes, a broker must be licensed in the state that they are doing the life settlement and have several licenses in life insurance, a viatical license, and a life settlement license.
Okay, that's a great place for us to stop.
Okay.
Life insurance has always been a valuable estate planning tool. However, the financial benefits are only reaped after someone dies. Today we learned not so with a life settlement. Since an existing life insurance policy is an assignable asset, it can be sold by engaging in a life settlement to a third party for more than its cash surrender value, but less than its net death benefit. The third party assumes payment of the premiums and becomes both the owner and beneficiary of the life insurance policy. In other words, all rights and benefits attributed to the life insurance policy are transferred to the new owner. This includes reselling the policy to other investors. We also learned that to qualify for a life settlement, the policy owner must be at least 65 years old with a potential decreased life expectancy. Also, the policy must have a minimum face value of $100,000. Moreover, since engaging in a life settlement has tax ramifications, always consult with your tax advisor before completing a life settlement transaction. Although life settlements can be a valuable source of liquidity for people who would otherwise surrender their policies or allow them to lapse, they are not for everyone. So educate yourself. A good place to start is by visiting www.t-horizons.com. Also visit www.finra.org. Click on both the Investors tab and the Protect Yourself tab to view the Investors alerts. In closing, I'd like to thank my guest, Dr. Andrea Brockman, the Chief Communications Officer of Lifetime Horizons LLC, for her participation on this program. Dr. Brockman, it's great to have had you on the program.
Thank you so much.
And as always, thank you to you, our viewers, for watching Your Money, Your Life. My name is Attorney Ramsey Bahrawy, Building Your Trust.